Canada's housing market appeared to be on the rebound earlier this year, but then the Bank of Canada resumed hiking interest rates. That's, of course, weighing on activity. Joining us now to discuss the health of the housing market, where things may go from here, is Rishi Sondhi, economist with TD. Rishi, great to have you back on the program.
Oh, thanks for having me, Greg.
So things have changed since the last time you were on. We were on pause at the Bank of Canada. You're seeing people take that as a sign of perhaps it's time to come off the sidelines, get in the housing market. We've had hikes since then. How are you reading this market?
Well, we've had a couple of months of hikes in June and July, and we've had housing data in June and July. And I would say on balance, it points to some resilience in demand that we're seeing. I mean, sales are actually up a little bit over that time period across Canada, and you're seeing sales rise in almost all provinces across the country over that time period, with the exception of Ontario and New Brunswick, where sales are down since the Bank of Canada started hiking rates. So I'd say that there's been sort of an element of resilience that we've seen sort of come through in response to the rate hikes, and you know, we're seeing that in sales. I mean, average prices are down, but those can be influenced by the type of home that's sold in a given month. Benchmark prices, which are give a sort of a truer indication of the underlying trend, are up over those 2 months. So the market is still quite tight when you look at measures of the month supply of inventory and the like. So again, resilience, I would say, is sort of an underlying theme that comes through when you look at the data.
Yeah, when the Canadian Real Estate Association came out with a report earlier this week where they sort of gather all the regional reports, put it all together for us in one picture, it was notable that there were several markets, Calgary, I think Edmonton, and others that were actually showing some robust activity, and then it was Toronto that was weighing down the overall sales number. Is that a function of the fact that Toronto is already a very expensive market, maybe a little more sensitive to interest rates?
Yes, definitely. I would say that's for sure the case. We're seeing the intended impact of interest rate hikes really in Toronto's market. Sales are down about 15% since May. Prices are down for 2 straight months in Toronto and the GTA market. So that's really where the negative impact of the rate hikes really looks like it's coming through. But as you say, Calgary is sort of on the opposite end of the spectrum, right? With respect to how it's performing, sales are actually up 10% since the Bank of Canada started hiking rates. And there's a couple of things that I would point to that sort of explain that. I mean, one, they're having this robust interprovincial migration, so there are people coming from primarily Ontario into Alberta to sort of boost the market. And you got to remember that heading into the pandemic, prices were falling in Alberta, and they didn't go up over the course of the pandemic run-up that we saw. They didn't go up by as much in Alberta and Calgary as they did in other jurisdictions. So the market is still relatively well positioned to handle higher interest rates, and we're certainly seeing that come through.
Calgary having its moment right now in this cycle. When we talk about these higher rates and people trying to figure out what the Bank of Canada is going to do next, what about builders? I mean, we keep hearing the need that we need more housing supply. If builders are facing a higher cost of financing, are they going to start putting some projects on hold until they figure out what's going on?
You hear about that on the margin, I would say. You do hear that some groups are having some difficulty completing projects because of financing cost issues. But I would say on balance, housing construction is still quite robust. When you look at housing starts, just got that data yesterday, housing starts were about 250,000 or so annualized units, which is a huge number and well above pre-pandemic trends. So we're really still, breaking ground on a significant amount of properties near multi-decade highs with respect to buildings. So, I would say that perhaps on the margin it's having an impact, but, builders are still doing their thing with respect to breaking ground on projects. Part of that, I think, has to do with the fact that the level of price is so high. So their bottom lines are getting insulated to a degree by the fact that prices are so high.
I know that you co-authored a report with some of your colleagues at TD Economist that came out near the end of July talking about the robust population growth we're seeing in the country. On the headline, a lot of people worry about what that means for housing demand, and that supports the housing market, but where are we going to get the units from? But I found it fascinating. You really started digging into the sort of the demand side of it. More people in the country are going to, pull some demand out of the economy. Might mean that interest rates have to stay higher for longer. If that's what happens, what does the housing market look like longer term? The question I get from a lot of people when I do some stuff outside of the show is like, oh, so when are the cuts coming? When are the cuts coming? It's like, I don't know.
Yeah. You hit the nail on the head, right? I mean, if population growth continues to be robust, like last year we saw over 1 million people come to the country, population growth continues to be strong like that. I mean, just obviously the impacts will be felt in housing. We estimate that, in our sort of our baseline scenario, we could be short 200,000 units or so, 200 to 250,000 units or so over the next, 3 years. That never could swallow 500,000 if population growth is extremely robust. That's one impact on housing. And now with respect to interest rates, yes, because population growth is, as the report calls, sort of a textbook demand shock. That's putting upward pressure on demand. And in that environment of robust population growth versus a situation where population growth is, say, closer to its long run average, interest rates would have to be higher to sort of weigh against that demand and keep inflation in check.
Almost take us to a place where there's a higher, I guess, neutral rate, that place where the central bank feels like we're not stimulating the economy, we're not trying to tamp it down. I think people have an idea in their head what they've lived through for the past 10 years or 20 years about where interest rates are going to settle out. Maybe that's not the reality going forward.
Yeah, I would say so. I mean, as I'd mentioned before, because of this robust population growth, if it were to be maintained, again, interest rates would have to be higher, than relative to a situation where we saw population growth more sort of in line with historical norms. I would say our neutral rate forecast, and I believe is around 2.5. I'd have to check, but I believe is around 2.5%. So we think maybe the policy rate over the long run could settle around that level. And again, that's boosted by the fact that population numbers have been strong.
So these are some of the longer term things we need to take a look at as we sadly in the next several weeks, say goodbye to summer, head into the fall season. What does the housing market look like? Is it all going to be dependent on what the Bank of Canada does next?
Yeah, well, I mean, the bank, but also, more broadly bond yields, right? So that's a function of the Federal Reserve, the economic outlook. So there's lots of things that influence bonds. Bank of Canada, of course, they've hiked rates. They've done their 50 basis points of tightening. We think they'll remain on hold for the remainder of the year. But those hikes are sort of baked into the system, and they're having some impact on demand. Prior to this, demand was going quite robustly, and it has sort of petered out a little bit. So certainly we're seeing some impacts. Also, we've seen bond yields sort of grind higher, and that's likely to put some upward pressure on mortgage rates, which of course would slow demand. So in our forecast, we have in the second half of the year sales falling a little bit and prices sort of flattening out overall, at least in markets like the GTA, for example, and then in the third quarter, and then actually dropping a little bit in the fourth quarter. Across Canada, we see average prices falling in both the third and fourth quarter of this year. So sort of in the near term, we do think that rates will have some impact on the market to the downside.